Let me ask you a question. Where does money really come from? Now, if your first thought is a government printing press, well, you're only seeing a tiny, tiny piece of the puzzle. The truth is, the vast majority of money in our economy is created every single day, inside commercial banks. And once you understand how it works, you'll never look at the economy the same way again. We all kind of have this mental image of how a bank works, right? But what if I told you that idea, the very one that's still taught in a lot of economics classes, is basically completely backward? What if banks aren't just moving money around, but are actually creating it? You know the image I'm talking about. We see a bank as this giant, secure vault, a big money warehouse. You put your savings in, the bank holds onto it, and then it lends that exact same money to somebody else. It's a really simple, logical story, except it's not what happens at all. It's a fiction. Okay, so before we get to the truth, we first have to really understand the old story. Let's call it the textbook tale, the theory known as the money multiplier. So the textbook story goes a little something like this. You walk into a bank and deposit $1,000. The bank is required by law to keep a fraction of that, let's say 10%, so $100, as a reserve. Then it can lend out the rest. That's $900. Now, the person who borrows that $900 goes and spends it, and whoever they paid deposits it in another bank. That second bank then keeps 10%, which is $90, and lends out the other $810. You see where this is going, right? The cycle repeats over and over, supposedly multiplying your initial $1,000 into a whole lot more money throughout the economy. The absolute key to this old story, the main takeaway, is that deposits come first. Your savings are the raw material, the seed that's needed to create a loan. The whole system starts with you, the depositor. The only problem with this neat and tidy story, it's completely wrong. All right, so now let's pull back the curtain and take a look at how money is actually made in the real world. And just a heads up, this turns that whole textbook model completely on its head. You don't have to take my word for it. This quote from the Bank of England, one of the oldest central banks in the world, lays it out perfectly. A bank doesn't wait for a deposit to make a loan. When it approves your loan, it creates brand new money right then and there, just by typing numbers into your account. The loan creates the deposit, not the other way around. Here's what it looks like on paper, on the bank's own books. When a bank gives you a $10,000 loan, two things happen instantly. First, the loan itself becomes an asset for the bank. That's money that is owed to them. But at the exact same moment, a brand new $10,000 deposit appears in your bank account. For the bank, that deposit is a liability. It's money they owe to you. The balance sheet just got bigger on both sides. And just like that, poof, new money has been created, literally out of thin air. So let's just put these two stories side by side to make it crystal clear. The old story says deposits are lent out. The real story is that loans create deposits. The old tale sees banks as simple middlemen, just passing money along. The reality is that banks are active creators of money. And maybe the most important difference? In the old story, the bank's reserves are what limits how much it can lend. But in the real world, the main thing that limits lending is simply whether a loan is profitable and a good business decision. Okay, so if loans create deposits, then what on earth happened to that money multiplier we all had to learn for our Econ 101 exam? Well, it turns out the world's top financial institutions have some pretty strong opinions on that. I mean, it doesn't get much more blunt than this. The International Monetary Fund, the IMF, flat out calls the deposit multiplier a myth. They see it gets the whole process backward. See, in reality, banks don't check their pile of reserves and then decide if they can make a loan. They find a credit-worthy customer they can lend to profitably first, and then they figure out the reserves later. The loans lead, the reserves follow. And if you need a smoking gun, well, this chart is it. This shows the so-called money multiplier in the US. For decades, it kind of bounced around, but just look at what happens after the 2008 financial crisis. Central banks pumped a massive amount of reserves into the banking system. Now, if the multiplier theory was true, lending should have exploded, right? But instead, the multiplier completely cratered. It collapsed. And why? Because as the caption says, it was never really the thing driving the train in the first place. So if the textbook rules are a myth, what are the real rules? I mean, if banks can just create money with a few keystrokes, what's to stop them from just creating an infinite amount of it? And that is the multi-trillion-dollar question, isn't it? The good news is, while those old limits were fake, there are very, very real constraints that keep the whole system from spinning out of control. Here are the real-world limits. First and foremost, profitability. Banks are businesses, not charities. They're only going to make a loan if they think they'll make money on it. Second, risk management. They have to be confident you're actually going to pay them back. Third, and this is a huge one, capital requirements. Regulators force banks to have enough of their own skin in the game, their own capital, to be able to absorb losses if loans go bad. And finally, there's a whole web of other complex regulations around things like liquidity that make sure they operate safely. And if you need one last final nail in the coffin for that old textbook theory, this is it. In March of 2020, the U.S. Federal Reserve officially reduced the reserve requirement ratio to 0%. That's right, zero. Banks in the U.S. are not required to hold any specific fraction of their deposits as reserves anymore. This move simply made official what was already true in practice. Reserves were never the thing that was actually constraining lending. So we've established how the money gets created out of thin air. Now for the next logical question. How do banks actually turn this magic trick into cold, hard profit? It all comes down to a simple concept called the interest rate spread. Just think about it like this. The bank creates a car loan for you and charges you, say, 7% interest. At the same time, it might pay other people with money in their savings accounts maybe 2% interest. That 5% difference between what they earn and what they pay out, that's the spread, and that's the bank's core business. Let's just state this as plainly as possible. The bank's business model is not about taking your $1,000 in savings and lending it to your neighbor Bob. It's about creating a brand new $50,000 loan for Bob out of thin air and then profiting from the interest spread on that new money for years to come. And if you're wondering how important this process really is, get this. In a modern economy like the UK or the US, about 97% of all the money that exists isn't physical cash and coins. It's digital money, it's bank deposits. And the vast, vast majority of that digital money was created in the exact way we've been talking about. At the very moment a bank decided to make a loan. Look, once you realize that loans create money, it changes your perspective on everything. It means our money supply literally expands when banks feel confident and are making lots of loans, and it shrinks when they get nervous and loans are repaid faster than new ones are made. So this brings up a huge question for all of us. If the very creation of our money is tied to the act of borrowing, to us going into debt, what does that really mean for economic growth, for financial stability, and for the future of our entire economy?